So we're still on day 27. It's not even 8 a.m., but it's getting there. And this will be video number 2, and this will be on Tesla. The other video, which will be behind this because of the way Tradingview stacks up your videos, is the important video. You really should listen to that and be open-minded, because for some people it will be um, one large epiphany. But in order to do that, you have to be prepared for markets to change. And when you trade, you want markets to basically go in your direction, not against you. You do not want to get stopped out unless you have a problem with success. And then probably on that reason alone, you should not trade, because it's very easy to lose your money. And if you want to lose money, I would say do it with trading, and don't think about your trade. You'll lose your money. So, but also, if you want to trade, you have to think about what the market's doing that's running against your position, and you can learn to do that. But it takes some thought, and usually, when you're not really very good at it, it's hard to do it when you're consistently losing money, or losing money to the extent you're really worried about your trade every time for all kinds of reasons. Did I get in at the right place? Am I going to get stopped out? How much money should I make? There's a hassle if you're ahead $1,000. That's stressful, because you say, well, maybe I should take it because I'm not having an easy time trading, and then it goes up $3,000. The market is made to really be very upsetting unless you condition your ego, and it's not just your ego, it's your analytic abilities to decipher the market to give you an edge. And it takes active participation, in my opinion, to do that. It's not you're not going to find a computer program that'll do it all for you, because even the program will have losing trades and it's going to screw you up. Yeah, you're almost doomed to heartache if you think there's a simple way of doing this without using your brain. So it's just, and the market has it built into it. The market, remember, it has the smart money, and the smart money, or somebody smarter than you decides, well, I'm going to buy, but you're short. And, um, there's a reason for it. The market is trading to all kinds of traders, but there are these algorithms. And when you're beginning trading, at some point you will get the sense, something's not going right with my trade. I'm really worried about this trade, and mostly it's because it's getting close to your open. If it managed to get in your favor in the beginning, and something's not right, but it's hard to be objective. It's very stressful because it means that this could be a losing trade, or you lose opportunity because you got spooked out of it and you're kind of pissed. And you have to work some of these things out without jeopardizing money, because it completely disrupts your personal psychology and the willingness to be objective. I mean, you want to get out making money, and if you're healthy. I mean, you may be crazy, but if you trade to lose money, that's not a good thing. That's a big problem. You probably shouldn't trade. Um, you should donate your money, but unless you like misery, and like losing. But generally, I found it very stressful to lose money. So I'm assuming other people are like that. So you want to learn patterns and things that don't threaten you, because a market's about ready to change in direction, and you need to know about it. You can address it. I think the last video is an example of things you could have done. Sometimes the only thing you can do in a bad trade, because that's just the way it is, if you were objective, is just get the hell out of it. It's not working right. Sometimes it'll trade against you, but it'll have a correction so you can minimize your loss. That's what the last video was partly about. And sometimes you can think like a buyer, but in fact, if you stay a little bit longer while the market was working against you a little bit, you can recoup some of that, especially if you have the ability to scale in and out, or you can become a reverse trader and actually change direction because the trade location is different because of the dynamics of the market and where that location is. And that's a summary of what happened on the last video, but you have to think about it, and that's not something you figure out in a month or two or a week or two. It took many years for me to figure this out with lots of training, lots of effort, and periods of time where I had to stop trading, trading, not trying to make money. You can make it elsewhere than trading, and sort the pieces together so that I could be more objective without fear of loss. Now, this is 5 minutes. Let me go and complain about something here on Tesla. See, I don't like harmonic patterns. I don't like them because they clog up my charts. They're a pain in the ass. And most people have no freaking clue why the pattern works. It's a black box, but it isn't, but it is. And you're told that you should have certain parameters, reversal areas, and if you do it long enough, you'll get to the fifth point, the fifth pivot, and you'll have, in this case, a gartly pattern. So you have a very bullish move like this. I want to make sure that's the bottom. It is. That's the X. And the market moves higher, and then you can find yourself trading the correction lower. And this correction, and in order to do this with a gartly pattern, you need to have an X here. You have I don't know if they call it a letter or a number. I used to know, but I'm getting old and I just don't know which one it is. So I'll call it I'll call it both an A or a 2. I think they call it letters. I don't know. But somehow with that, you're supposed to know that the market does this, and that has to have Fibonacci conditions. If you look, just Google it. If you don't, if you trade these patterns, you'll know what I'm talking about. If you don't, you can Google it. You'll see all the criteria that people put on it, using usually Fibonacci relationships, but they don't really have, it doesn't really explain to you the dynamics of the market. And there are many patterns. I like shark patterns. I think they're kind of neat, but I don't need a shark pattern because I know what the pattern looks like. I don't need any parameter, any of that stuff. I see it and I can trade it. So if a market does this, basically does a little thing like this. I don't know if I'd call this the shark pattern, but I know where to trade where the Gartleys tell you to trade. But I also know that a Gartley isn't a Gartley, as is true with all these patterns, until it meets all criteria. The first pivot, the second, the third, the fourth, the fifth, and now it's a Gartley pattern. It's an ABCD. It's not an ABC. Well, I call it an ABCD. It's a 1, 2, 3 swing after the market has an impulse like that. That's my words. And Gartley looked at that pattern and thought it was a highly probable pattern to make significant new highs because he figured he found the reversal. And the correction, if it's a pattern like this, has a lot of probability to go a lot higher. Now, there's a guy, is it Mikowski or something? There's a guy who has has books that analyzes probabilities. I had his book before. I liked it. He had some interesting observations. He's a very well-known guy, and I'm sure he talked about, but not 100%, sure that he talked about Gartley patterns. So, but without all the dynamics of an official uh, harmonic pattern, the market was showing you lower lows and lower highs. And this part of it is not Gartley. It's just an ABCD pattern that gets you down to where the market found buyers and gapped higher. All of this is that. So the market, not just that, if you didn't do this ABCD pattern, you could have done this. A, B, it corrects like this, starts going lower. We do this every day, this kind of thing, and this is just a retest, and then it comes down to this area. There are two ways to get to the observation that when the market gapped here, it was likely to go lower. And it would either go lower based on a pattern like this, because it's very bearish when it has gaps like this, or it'll go lower because we were looking at a gartly pattern. The difference is this is a reversal pattern. A gartly is associated with a major transition in the market that's going higher. I don't trade gartly patterns. One of my mentors that I always say nice things about because I'm that appreciative of what his insight meant to me is Larry Pesavento, and he looks at these patterns all the time. But at the time I asked Larry Pesavento for his help, my one condition is I don't want to talk about gartly patterns and these patterns, these harmonic patterns. And he was gracious enough to say, no problem, we don't have to talk about them, because I already had my conclusion and I made the right decision for me. So, and then he taught me stuff that I didn't know I needed to know. And that's what really helped. And it wasn't the harmonic patterns. So in any case, the market has traded considerably lower. I don't really think in markets, overall in the markets, that this is going to make all-time new highs because it's a gartly pattern. I'll look at the support, resistance, and all the things that I think is important. But the one thing that's very important, and I'll say it and then stop this thing, the thing I didn't like about gartlys are two things, not gartlys, all harmonic patterns. They don't really come into effect until you've met all criteria of all 5 pivot areas. And then you go long. You don't, that's what you would do here if it was a gartly. But for me, I'll go long if I see buyers. And I'll go long doing the things that I do, but it won't be gartly's reason. Okay, it's not, I have to see where there will be buyers, and I'll have to look and see all the things that I talk about for the past 4 years here. So, but what I don't like about them is that sometimes the market can contract. This is what I like to use and talk about, expansion and contraction. And a lot of times in these patterns, the market will lose the lines of your pattern. You can put the pattern in, but it loses because if a market coils or rages for a long period of time, it distorts the pattern. They're not the clean patterns that you look at when you Google them and you look for harmonic patterns. They're easy looking patterns, but in reality, they're not so easy looking because markets change in ways that really distort your viewpoint or even your perception of, let's say, a gartly in this case, because it's doing crazy things and it still may get down to here, but it won't be nice and pretty. The reason why it wasn't so bad here is that the market in general has enough volatility and symmetry to it. So, and you don't have to worry about the price drifting so far away in the middle of a swing and you think that you can't even see how it could be a gartly. It just didn't happen here because things up here didn't get that bad. But it's not because, it's because of luck it didn't get that bad. So, but the luck is that the market's just trading. It's not consolidating anywhere. It's moving. It's doing this. So, but I'll show you distortion versus clarity, okay? Even though this worked as a gartly, well, who knows? If you believe it's a gartly and it's going to go higher, it's a reversal pattern. It's a gartly reversal. So what makes my point is just getting rid of the clutter that basically seeps forward and destroys your pattern, and that way is to use the next higher time frame, a weekly chart. And now when you look at a weekly chart, it's easy to see the swings. There's no distortion. And there's a nice, pretty gartly. There's a gap here. So that'll be interesting. If the market can't close this gap, that's why I like this. Now that we're looking at it and it starts finding buyers, maybe these buyers will hold the market and the market will start to correct lower. That's a little side note so I can finish the official part of Tesla. But what happened here is the market basically traded without, I got rid of the clutter that distorts the pattern. This pattern looks perfect because I eliminated the smaller time frame that could have gone, it could have not only done this, but it could have just gone all the way over here that no longer looks like a gartly. The gartly, these patterns are, they're not subjective, but they're you're told what your parameters are. That's basically what happens. And you study the parameters, but you're not studying the dynamics of a market. You're looking strictly at a pattern that easily just they just disappear before they ever get to the fifth point. X, 2, 3, 4, 5. And they never get there. They almost get there. That would be an example, and then they drift off. You never get to trade. So if you are a hardcore um, um, uh, harmonic pattern person, this is, you don't short this because it's a gartly, because it isn't a gartly until it gets to here. So in the meantime, we're shorting it, and we'll go long, and we'll find reversal areas and gaps and all the rest of that, because we're reading the dynamics of a market, not an artificial um, uh, algorithmic pattern developed by somebody who programs or uses a programmer, and that's why I don't like them. You can read the market better and make better trading decisions. An example could be the last video on coffee, but it's a complicated analysis there. Not that complicated, but you won't be able to do it if you're in the process of losing money. You need to learn how to look where buyers and sellers are when you're not in jeopardy as a buyer and a seller until you become comfortable with the patterns. And you don't even use stuff like this. You just look at how the markets are moving and coming back to where they were and historically, and make a trade decision. Whatever I said, I'm not sure what that means, but I'm thinking about the last video. So, and learn how to read where the buyers and sellers are. Basically, that's what I'm trying to say. So that's enough of this 17 minutes. I have nothing more to say on Tesla. I wanted my student to see that it would probably go lower. I pointed out that it could be a gartly pattern, and it did go there. Is it a gartly pattern? I don't know the answer to this. Yeah, I think I do. But if the market continues going down and this swing goes down to here, is that a gartly pattern? I would say it traded out of the gartly. I don't know. I don't care what a gartly is. I know that the market is still bearish, but it might find buyers here. So if you wait for the gartly and you say, well, gee, I'm supposed to trade it up to here somewhere, and you took the trade because it met the pattern, what the pattern's telling you. Well, if you go long here and the market continues going lower, you lost money on your gartly. So it's only as good as you are at the end of the trade, I guess. So in any case, that's it. And I don't, no more time for videos today. Hopefully this will be useful to some people.